right, good afternoon, everyone, and welcome to our Twitch TV live stream. Today we are doing part 2 of our mini-series, which is how portfolio growth made easy. So today is part 2, and on Wednesday, when we normally do the mini-series, we're going to be doing a hot stock panel with me, Todd, Steve, Jim Penna, and myself. Because let me tell you something. Man, the way the market's been going down, contra ETFs are a great way to make money. We've been talking about that. Good afternoon, Max. Drinks on me, says King Lucci. All right, so today we're going to be talking about part 2 of our mini-series. As I mentioned, for those of you who are new, my name is Glenn Tompkins. I'm a senior instructor here at VectorVest. Been here 15 years. 15 years. I work for VectorVest, which has been around for 30 years. The VectorVest software is a tool designed to help you to make better decisions in the stocks that you buy and sell. If you are new to the market, you're in the right place to learn more about the market. If you are a veteran of the market, you're in the right place to learn more about the market. So today, in part 2 of our series, we're going to be talking about market timing, and I think that this is the perfect time to be bringing market timing into play. Due to what's going on in the market with the tweets and the fear in the market, it's more so news-driven fear. I want everybody to understand that it's more about news-driven fear that's driving the market right now, but it could be putting you in a sense of, is it time to go short or not? We're going to talk about that. Part 2 of our portfolio growth made easy. Last week, what did we talk about? We talked about our finished product for the plan your trades, trade your plan, right? Let me go into the software real quick, and let's go find that portfolio. Where's my mouse? Let's go find that portfolio. I want you to see that, and we'll just go to portfolios, and we'll use that. All right, so in our plan your trade, trade your plan portfolio, we came up with a full-blown automated trading system. So now with the market going down, right? What's up, Keva? That MACD short search you showed us how to do Friday been alerting me like crazy. Listen, that's one of the tools, and we're going to use that tool again today. Even though we're going to talk about your portfolio and market timing, we're going to touch on what to do with that, with the watchdog to help you just in times like this. Hello, Texas. Who is here from the Dallas user group? And that's Alessandra. Alessandra is asking, who is here from the Dallas user group? Just type in the room, me or yes or something. Wow, Rhode Island just drew up 100. That's a lot. Woo! Man, I got a lot of cheers coming in today. Thank you guys for that tremendously. Thank you so much. All right, let's go look at that portfolio. So I haven't taken a look at that portfolio since the market trended down. Let's see how it's affected the portfolio. Remember, this portfolio was up almost 20% or over 20%. Right now, today, look at that down. With today's market, this portfolio is down 3% today, but notice it's getting rid of stocks. All right, this is normally a 5-stock portfolio, and here's all of the notes behind it, what stocks are getting let out, and looking for new stocks. But man, look at that, 3%, still up over 14% since we set this portfolio up in March. Now, when we talk about how to grow your portfolio, this is part of that. Understanding how to put things into perspective, put things into play so that you can put together a really automated portfolio that is pretty much hands-off, that you've already done the work behind. So this still portfolio is up 14.5% since March, April, May, June, July, August, almost 15, let's say 15%, that's almost 3% a month. Anybody not happy with that? Almost 3% a month, and if that holds true all the way to the end of the year, that's 36% in a year. That's 36% in a year. Anybody not happy with that, all right? And this is, we walked you through how to get to the point where you could set up a full portfolio that you've planned out and that you're trading the plan on. So in the whole idea of portfolio growth, having something put together that you can effectively grow your portfolio with hands-off is the main goal that you're trying to get to. Part of setting up this portfolio was to use market timing and finding the right market timing to accommodate this kind of portfolio. So that's what we're going to talk about today, is primarily the market timing aspect of trying to grow your portfolio. Now, For many of you who may be new and you hear the words timing the market, you may be thinking that, wait a minute, nobody can really time the market. Well, it's not about predicting which way the market is going to go. When we time the market, because we are trend followers, we stick to the trend of the market and keep you guys on the right side of the trend. All of our market timing signals are generated off of market trend. Depending on how aggressive or conservative you want to be, we do have a market timing signal that will accommodate everybody in this room. Glenn, could you show me in the graph when a confirmed down will be? Yes, I will do that. All right, because we're going to talk about market timing today. So I got you. All right, so a big part of this whole portfolio growth is market timing. Let's go to the graph. There's our market timing graph. Let me bring it up on my side. This is what's going on in the market. Now, the indicator that you see on the screen, this is something called the VVC, or VectorVest composite. VectorVest composite. The VectorVest composite is an indexed arithmetic average of all of the stocks that we track. In the software right now, we currently track 8,363 stocks. So when I'm looking at the VVC, or VectorVest composite, I'm looking at an indexed arithmetic average of all of these stocks traded in one symbol. Now, you cannot trade this symbol outside of VectorVest. It is a means of being able to track the average price of all of those stocks. And currently, as of right now, the average price is $46.10. This looks at the stocks that are $500 all the way down to the stocks that are $1. All right, looking at the average price of all of these stocks and keeping in mind, watching the movement of 8,300 stocks is more in-depth than tracking the movement of 30 stocks, which is the Dow, or the S&P, which is 500 stocks, or the NASDAQ, which is about 4,300 stocks. Our composite tracks the move of 8,300 plus stocks in one ticker symbol. So when I go back to that graph is tracking the movement of all of those stocks in one symbol. Now, tracking the movement of all of those stocks gives me a better feel of when the market is really moving down and when the market is really, let me move that over, gives me a better feel of when the market's really moving down and when the stock market is really moving up. Now, if I go to look at what's going on now, the market is really in a downtrend. Let's go to 3-month graph. Look at that. From the high, which created a beautiful level of resistance, the market was not able, the VectorVest composite was not able to break through that level of resistance to show a continuation of higher lows and higher highs, which is an uptrend in the market. Not only that, the market was in the midst of a sideways move, or midst of a channel. And finally, this is Monday, Friday, Thursday. With Thursday's move, we broke out of the channel. Friday, we had more confirmation of the down move with a gap down. And today, even more confirmation of a down move with the gap down and the market now, look at that 3 days in a row. So I'm going to start off with the slowest, most conservative timing signal we have, which is called the confirm call. All right. Now, what I'm going to do is put that on. You'll notice red arrows and green arrows, which will denote a confirmed down call. Look at that. Look at that. Confirmed down call to a confirmed up call. Because it's the slowest timing signal we have, it will not get you in right at get you out right at market tops, and it will not get you in right close to market bottoms. Notice that it took a while before this confirmed up call signaled, because there's a lot involved for that signal to turn from a down to an up. Let's go put on the buy to sell ratio, and let me explain to you how we get a confirmed down call. Let's start there. Alessandra asked me when we can get the next confirmed down call. Let's start with the last down call we had, which was on 5/8 of 2019. How did we get a down call? Well, the price of the composite, remember, which tracks the movement of 8,300 stocks, the price of the composite has to go down for 2 consecutive 5-day periods. 1, 2, 3, 4, 5. The price on the 5/8 was lower than it was 5 trading days prior, which was 5/1. All right, so let's go to 5/1. Let's go 1, 2, 3, 4, 5. The price on 4/24 compared to 5-1. The price was lower than it was 5 previous days. So 1 5-day period down, 2 5-day period down, and the buy to sell ratio went below the value of 1, thus giving us a confirmed down call, the slowest, most conservative timing call. Currently, let's go count back 1, 2, 3, 1, 2, 3, 4, 5. The price is definitely lower than it was 5 days ago. This is the problem where we're having a problem. Watch this. 1, 2, 3, 4, 5. The price is higher than it was 5 days ago, so I can't get a confirmed down call. What we need to get through, Alessandra, is more days where the price, where we can get lower than we were 5 days ago. That is where we're stuck. Now, when we're in the channel, it's going to take time for us to keep going further down for the price to close down for 2 consecutive 5-day periods in a row. That is what's stopping the confirmed down call. But a lot of that is because we were in a sideways moving market. It's faster and easier to get a confirmed down call once the market has gone up and turned around instead of gone up and sat in a channel. Does that make sense? 2 more days, primary confirmed down call. 1, 2, 3, 4, 5. That could happen then. Could it happen tomorrow? Nope, it could happen tomorrow. Let's say down. 1, 2, 3, 4, 5. 1, 2, 3, 4. Nope, won't happen then. Let's go 2 more days. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. That could happen. So in 2 more days, Kirby is right. In 2 more days, we could get a confirmed down call. I had to think about that in my head for a little bit. In 2 more days, we could get a possible confirmed down call. But wait, that is the slowest, most conservative timing call. So if you're a longer-term investor, this is a great call for you to use where it doesn't trigger a lot of different calls. Let me show you something. Let me put this on a 1-year graph. Over the last year, 1, 2, 3, 4, 5, 6 calls. So it's almost 6 calls throughout the year. So 1 call every 2 months. That gives me a lot more time to be stable in stocks, whether I'm bullish or bearish, without having to get in and out, in and out, in and out, in and out of the market. 6 calls over the last year, averaging out to 1 call every 2 months. So that's where we stand. I got so much stuff around my desk. So that's where we can get where we get the idea of knowing what's what and how to handle it. So the price of the composite has got to go down for 2 consecutive 5-day periods. The buy to sell ratio is already below the value of 1, so that's already there. So we need a couple of more days before we can get a confirmed down call. Now, how many of you consider yourselves to be a longer term investor? Type a yes in the room. Remember that time when the Yanks blew a 3-0 lead in the playoffs to Boston? Yeah. Remember the time where Boston got swept over the weekend? Oh, that just happened? Oh, yeah. So you want to keep talking. All right. So Alessandra said me. All right. So just keeping all of this in mind, market timing is very, very so important, number one. And number two, knowing what kind of investor you are is so important. If you're a longer-term investor, make sure, out of all of the market timing signals we have, make sure you use the signal that is right for you. All right? If I'm a longer-term investor, knowing that I can be long and stay long, knowing that I can be short and stay short. No matter what timing signal you use, though, can you be susceptible to whipsaws? And the answer to that is yes. All right? Deacon says swing long-term. So from a long-term perspective, the confirmed call is a good way to be. Let's speed this up a little bit. More of a swing trade. Let's move from confirmed call to the DEW, which looks at, this is our technical timing signal. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 calls within a year. Almost 1 call per month as opposed to 1 call every 2 months. This is a little bit more of a faster timing signal, and the faster the signal, the faster the exit or entry into the market. Coming in off of a low, coming in off of a bottom, it got you in a lot faster. coming off of a top. This nailed the top actually. That was a down call right after the top. How do you know when you have a top? When the market stops going up and it starts going back down. That nailed the top. That doesn't always happen. Here's another top. Got you in coming off of a bottom, pretty early coming in off of a bottom, off of the top, 2 days, 3 days off of the top, off of the bottom, a few days off of the bottom. Look at right now, how far off of the top, right at that level of resistance, a couple of days off the top. This is a great timing signal for the more swing trader, more like the Deacon Blues. How many people consider themselves more swing traders? Type a me or yes in the room. How many people are more or less swing traders? Type a yes or a me in the room. And this is a great timing signal. While you're typing that in, let's talk about the type of how this works. The DEW time. I got new lips today.
Spit it out.
I'm trying to.
Jeez.
The DEW timing signal is our technical timing signal. It uses 3 technical indicators. D, which stands for the detrended price oscillator, all right? The DPO, which oscillates around the 0 line, which is that flat line. Above the 0 line is bullish, below the 0 line is bearish. E stands for envelopes. We give you the upper and lower range of envelopes, which shows you the upper and lower range of price. We can use the envelopes because to get to an extreme, you break below the envelope or break above the envelope. That shows you market extremes. We almost broke through the envelope going down on 12/24/2008 with the big pullback to the downside. There we go. We got Billy Bob. Billy Bob is here. Where's Billy Bob? I don't see. Oh, there's Billy Bob. So we got somebody in here from the Texas user group, from the Dallas, Texas user group. Glenn, you need to give some badges to Billy Bob from Dallas. Listen, I will give badges to who I want to give badges to. So there, Alessandro. You got that? Do I have a VIP badge to give today? That was me putting my foot down. You got that, Alessandro? I put my hand and my foot down. Let me see if Daniel, do I have a VIP badge to give out today? No, that's not mean. That was just me telling you that I might think about it. I can't afford. Kirby says market timing just broke 46.01 support, now headed south to 45.62. We're going to look at that. Did we have a level of support? I'll bring that up in a second. Glenn, check. No, don't get me. Don't put that out there. No, Kevin. It was just me being playful. Don't start. Don't start none, won't be none. Kevin, don't start none, won't be none. Daniel, do I have a VIP badge to give out today? And that's not on my sheet, but do I have one? Yes or no? Joey, do I have a VIP badge to give away?
I think so, no.
Dang it.
Only got a couple left.
I know you do, Alessandra, and I love you too. So I don't have one. Can I make up one? Can't you give me one just to give one away?
We can. Give one.
You can give me one? Daniel didn't say nothing. You know something? Do me a favor. Who's here? Where is Keva? Kevin, can I have 2? Can you stretch me and give me 2?
I'll give you one.
Before I give it to Billy Bob, I got to pick a choice between Billy Bob and Keva. I got to think about this. I know Keva is new. I know Billy Bob might can wait because I know Billy Bob personally. All right? But Keva's new. Keva's new to the room. Let me think this out. All right? Yeah, let me think this out. All right, so give it to Billy Bob, says Kevin. All right, so give it to him. Can you make it happen? All right, Billy Bob, I'm getting ready to give you a VIP badge. I'll give you $5 to give to. Wow, no. I just gave it to you, Billy Bob. You got a VIP badge.
No, we'll take that.
We'll take the $5?
Yeah, we'll take it.
Wow, Joey is all about the money. All right, so looking at this indicator, how do we get a down call? All right, let me tell you the third part of the DEW. The W is the weighted moving average, which is this little line. Let me see if I can make that line a little darker. Change the style. Let me make that a little darker so you can see it. Let's get this color. There you go. There's the 30-day weighted moving average. So what happens is, in this scenario with the envelopes and price tends to stay between the envelopes. Why? Because that's showing you the upper range of price and the lower. Price is always going to try to stay in the middle. When the market gets to be outstandingly over anxious, it will break lower and lower, and the lower range of price will get challenged. The lower range of price will get challenged, and when it breaks through, it shows levels of extreme, and the market's going to rebound just like a rubber band real quick. Notice that how quickly we got to that level of the extreme on the envelope. Look how fast the market rebounded. All right, so it's sort of like a rubber band effect. Sort of like a rubber band effect. Now, to get a down call, let me zoom in. To get a down call, the price of the composite needs to break below the 30-day weighted moving average. Notice that it did that here, but we didn't get a down call. Why? Because there's a second piece to it. The DPO needs to go below the value of 1, and that didn't happen until the next day, where the price was below the 30-day weighted moving average, and the DPO went negative. That is why we have the DEW down. How is the envelope calculated? The envelope, let me hold on right here. Envelope is a 10-day look-back period with 6% move in either direction. So it's a 10-day look-back period with 6% to the upside, 6% to the downside from the mean. Does that make sense, Steve? All right, so let me right-click. Let me change the settings. There it is. It's an exponential moving average, 10-day look-back period with an offset of 6%. With a 6% to the upside, so it's got 6% deviation to the upside to the downside. All right, that's a good question. Not many people ask me that question, but I know it, so that's why I can answer it. But I can change that. I can change it from the default if I want it to react a little faster. All right, but I'm not going to tell you to ever do that because this is set up for our DEW timing signal. So it broke below the 30-day weighted moving average, and the DPO went negative. And boom, we get a down call. Just the opposite to get an up call, the price has to break. Now notice that back here, when the market was moving up, look how many days it stayed above the 30-day weighted moving average, but it didn't trigger an up call until the DPO went positive. I like this timing signal strictly because it not only gives you one signal, there's a confirmation of signal. All right, so guess what, Billy Bob, you now just type something in the room, Billy Bob. You're going to see that there is a badge in front of your name. You now have been VIP'd. My Rogers, MTI, 0.60 is usually the bottom. When the MTI, and I'm going to talk about that in a second, Mary. Kevin got it?
They both got it.
They both got it, both of y'all. Thank you, Joey. So guess what? Kevin got the badge, and Billy Bob, type something in the room. You're going to now see a badge in front of your name.
Say thanks to Daniel.
Thank you, Daniel. Daniel made it, so I gave away 2 VIP badges today. There you go, Keva. There you go, Keva. You now got a badge. You've now been welcomed into the fold with a VIP badge within the room. And Billy Bob got one, too. I was able to give you both one. There you go, Billy Bob. You're welcome, Keva. You're welcome. So you both got one. All right. So that's the DEW timing signal. It is a great middle-of-the-road timing signal. Let me undo the zoom. It trades a little bit more often. Keep in mind, the faster the timing signal, the more trades that will be exhibited. If you're looking at this and you say, man, I don't want to trade this much, then this is not the timing signal for you. Whereas if I go back to the confirmed call, if you say that's more in line with the way I want to trade, then that's the timing signal you stick to. I'll sleep better tonight with that badge. Good. I want you to sleep better. I want you to know that we hooked you up. All right? So let's go to another great timing signal, which I like to call the green light buyer. Every time we get a green light in the color guard pricing column, so let me go back to the home page. Every time we get a green light in the color guard pricing column, like you see right here, okay, then it will trigger an up call on the green light buyer. All right, scroll down. All of these green lights that you see will be generated by way of a signal on the market timing graph. What are the light blue and red line? Let me go back to the graph. Light blue and red line. Those are envelopes. All right, that's the 10-day look back period with a 6% deviation. And the red line is a 30-day weighted moving average. So the DEW, write this down if you want, if you're new. The DEW stands for Detrended Price Oscillator. E stands for envelopes. W stands for a 30-day weighted moving average. Kevin asks, can we get those? Yes. If you go to the market timing graph, let me start off anew. If you change to a market timing graph and you go over to the graph layouts and select Pro Trader Timing Do, that's how you get this signal. All right, if you want to see the actual signals on the graph, go down to the bottom left, hit the drop-down arrow next to Confirm Calls, and click on DEW. Oh, you don't see that, do you?
There you go.
All right. So down below, you still don't see. Oh, I got to step out of the way. I can't do that. Oh, my gosh. There we go. So down here, we would see all of the market timing calls. Change it to the DEW, and go over to the top over here. Click on DEW. Man, see the stuff I do for you? I move around in my office so that you can see the full screen. All right, so that's how you get these signals generated on a graph. Now, I'm going to go back to the MTI layout, and I'm going to change now to the green light buyer. Look at that, coming off of a bottom, a good signal. So as we're coming off of a bottom, see how quickly this gets you in off of the bottom? That's a faster timing signal. Let's go to the DEW. It took a little longer to get you in off of the bottom, right? That's a little slower than the green light buyer. And let's go to the Confirm Calls. It took even longer to get you in off of the bottom. Can you put your left elbow in your right ear? No, I can't. All right, so there we go. So this is what I'm talking about in understanding market timing. Use the right market timing that affects you. Just because the green light buyer gets you in closer to the bottom, if you don't want to trade now in regards to the green light buyer, I really like this timing signal because not only does he get, stop laughing, King Lucci. Not only does it get you in, but it designates the days where it's okay to buy stocks. Does everybody see that? It designates the day in an upward trending market when it's okay to buy stocks. When I see a yellow light, that means I don't buy stocks until I see my next green light pop up in my daily color guard. That's why I really like this one, because not only does it generate the lights, but you only buy on the days of the lights. But not every green light is the same. All right, not every green light is the same, so we have another that helps you to stop buying stocks when the market is getting close to tops. Because you don't want to be buying long as the market starts getting toppy, right? So watch this. I'm going to go with the green light buyer RT kicker. Now we still have, notice that all my green lights as the market got toppy went away. Why? Because the market was getting toppy, and it's confirmed by an indicator called relative timing. Two moving averages on RT, a 10 and a 15. Notice that as we were still getting green lights up here, when I put this back on, notice that as we were still getting green lights up here, our moving averages of RT being bullish were not in conjunction with these green lights. Notice that the moving averages were bearish. They were moving down. This is why I like the green light buyer RT kicker a little bit more, because not every green light is the same, and it keeps you from buying into a toppy market so that you don't get caught by the market moving down like this. All right, keeping that all in mind. Now, what is good if you are swinging weekly? I like the green light buyer. I like the DEW. The DEW is ideally suited to keep you in when the market's down, keep you playing the market to the downside, to swing to the low side, swing low, swing chariot, coming forth to carry me home. Anyway, swinging to the downside, swinging to the upside. A little bit of a whipsaw right here, swinging to the downside again. So move this over, swinging to the upside. King Lucci, do you see that over and over from a swing trade perspective? This does a good job of keeping you in long enough to make money whether the market is up or down. All right, so this is a good swing trading timing signal. This happens to be the DEW timing signal. All right, so we talked about the green light buyer, the green light buyer RT kicker. How about if you're more aggressive and you want to play the market both to the upside and to the downside using green lights and red lights? So now, still using green light buyer and sort of using the red light seller. Red lights in the color guard pricing column with the RT moving down bearish. This is a great timing signal, being still in the middle of being aggressive, and this is more prudent. I think that this is more prudent because it does give you a good time to play to the downside, good time to play to the upside, downside, upside, back and forth, but it's confirmed not only by the red or green lights in the color guard pricing column, but also by way of our indicator relative timing and utilizing the moving averages on relative timing. This is also a good swing trade. Look how long you're in it. And how about, again, from a swing trade perspective, it tells you what days is okay to play the market to the downside. When you have yellow lights, you're not doing anything. Good days to tell you when to play the market to the upside. Yellow lights, you're not doing anything. And back and forth. This is a good swing trade one as well. And this, in actuality, between the DEW or the RT kicker combo, and these signals are only triggered end of day. The signals are only triggered end of day. All right, even if they pop up throughout the day, the signal is not solidified until the end of the day, preparing you for the next day. Does that make sense, King Lucci? All right, so from the swing trade perspective, to play both sides of the market, this timing signal, which is the RT kicker combo, does a great job playing the downside and the upside of the market, no matter what's going on. All right? So a lot of people migrate to either the combo or the green light buyer. If they don't want to play the market to the downside, you only get a down call on a confirmed down call. It uses the faster signals to get you in. It uses the slower signal to get you out. Now, for everybody in this room, do you now, whether you've been with us for a while or not, do you honestly feel better about market timing as of what I just explained to you? Yes or no? Type it in the room. And understanding what timing signals best fit what you're trying to do, does this make it a better understanding? Now, the reason why I ask the question is because it's an integral part on how to grow your portfolio. It's an integral part of how to grow your portfolio. Last week, we talked about what a good portfolio growth looks like, looking at our model portfolios, looking at the portfolio that we set up from Plan Your Trades, Trade Your Plan. This week is strictly for market timing and understanding the right timing to fit the way that you invest in the market. That's what it's all about. Because you could be in the best stocks in the world with the wrong market timing for you and still lose money. Just because we show or we feel that we like a specific market timing doesn't mean it's the right market timing for you. Look at these graphs. Can you trade this? I like the green light buyer. I like the green light buyer RT kicker combo because it does designate the right days to buy. Notice that as the market has been moving down, neither one of them have kicked over yet. Neither one of them has kicked over yet. A lot of that is because we're in the sideways moving market. I bet you tonight we get a signal where we get, in the RT kicker combo, we get a down call. Steve says, between the envelope and the 20-day EMA will make it easier to set sell limits for me. There you go. All right, so taking a lot of the fundamental knowledge that we've been dealing with right now and now tailoring it with other things is going to make this even better for you. My job is to teach you a solid foundation, and what you will do is build on that foundation. And as you build on that foundation, you're going to put yourself in a better position to grow your portfolio. My job is to show you how easy it is. You will add little bits and pieces to make it easier for you. And that's the beautiful thing about the software, is its flexibility to adapt to every person in this room to make money. That's important. It is not a one size fits all for everybody. That's the reason why we have so many different timing signals. It's not about, hey, this is the timing signal, go with it. Not everybody trades the same way. We understand that and we appreciate that, and that's why our signals are such that no matter how you invest in the market, there is a timing signal for you. All right, new people in the room that usually never talk. I want to know, was this information good for you? Is this useful? And I'm specifically looking at the people who are sitting in the background who never talk. I want you to answer, if you can today, was this beneficial to you from the standpoint of learning how to grow your portfolio? Hopefully I get a couple of yeses. I hopefully do. I always try to interact with everyone in this room, but I always know that there's a lot of people just sitting in the background. If you feel that this was useful for you, let me know. All right? So that's where we stand as far as market timing is concerned. Tell you what I'm going to do real quick. This is not on my list of things to do. What about using the 3A EMA bull bear crosses along with timing signals? You can do that, but that's something that I would want to talk about at a different point. I don't want to talk about it in this one right now, right? Because I want to keep it simple. Deacon, the 3 and the 8 is in addition to. For right now, though, I want to keep it simple. I want everybody singing from the same sheet of music from a foundational standpoint. So the stuff that I'm talking about is fundamentally sound, straight, narrow. There's a lot of stuff that you can add to make it better, to enhance it. All right? But I don't want to enhance it yet. I want to get you onto a path that's going to help you to grow your portfolio. All right. That's what I want to do. Poposity. When a stock has a large jump upward in price, or when you have to settle for a Mountain Dew, when you do not have your Cafe Bustelo. Wow. Did I really give that as a, I guess I did. All right. Tell you what I want to do real quick, because King Lucci brought it up. I want to bring up the RoboTrader. Oops, sorry. I want to bring up the Watchdog. Notice that I've got all these bearish ones. Let's go see what's popping. Let's go see what's popping. Let's go to, what did you say, the Watchdog on the MACD? Let's go see what's in here. I know. Let's go see what's in here. What's moving down? Wow, look at all of these stocks that the Watchdog. Let's go to the activity log. New stocks that have been coming in since we've been talking. Let's talk about some of these stocks. All right, this is since we've been talking. This tool has been in the background generating a list of stocks that are moving down. All right, let's go put this on a 1-month graph. Look at that. I got the 20 exponential moving average. How about AT&T? Just broke below it. Now, let's go put this on a 3-month graph. The stock has been moving up over the last 3 months, but look at that. Is that a good opportunity when the stock's price breaks below the 20 to get out? That may be a great opportunity to lock in profits. Let's go to the next one. Wow. FCPT. Hey, King Lucci, is this a stock that you would sell short? Oh, this is a trick question. Is this a stock that you would sell short long term? Yes or no? This is a trick question. Look at the graph. Answer it in the room. Is this, and this is a 3-month graph, would you sell this stock short long term? Yes or no? Because I said it's a trick question, nobody, there you go. Good answer, Kirby. Anybody else? Well, everybody can see it. The reason why I would say not for long term, Rhode Island says yes. Rhode Island's a lot more aggressive. Rhode Island's looking at price action. All right? I would say no, only because of rising earnings. Put this on the 6-month graph. Earnings is still high. Put it on the 1-year graph. Rhode Island may have a play in mind. The stock is definitely moving lower, but I would never like to sell a stock short long term that's got rising volume, rising earnings. Put this back. Let's go look at the next stock that was generated. Wow. Same thing with Google. Google has just been wicky-wacky. Look at that nice run up, and then it fell hard. Whew, that's a hard fall, but this is why you don't go against the stock that's got rising earnings. What did the stock's price do? Rose up, fell again. Something tells me that this stock is going to have the wherewithal to keep going up. Downward trend in defiance of their earnings. The market doesn't like them. I got you. So I do like how Rhode Island does a lot of background work on the stock. I totally understand. and I'm okay with that. But I'm not going to sell Google short for a long amount of time. Look how quickly that stock, well, not quickly, but how, rising earnings is the engine that drives the stock's price higher. I'm not going to touch that as a short. That's a closed-end mutual fund. I like this as a short, falling earnings. Stock moved sideways, but finally broke below that 20-day exponential. I wouldn't mind trading that one to the downside. Same thing with that. Well, be careful. Cons, retail, but Cons is over the last 1 year has been doing bad. It did have a nice resilient run up here, fell back down, tried again and fell back down hard, especially doing what's going on in the market. You can short long, but swing it as soon as it goes against you. I'm with that. I'm with that. All right, let's keep looking at a couple of more stocks in here. AMBC, overall, what's the trend of the stock? Downward trending stock. Downward trending stock. And the stock's price can't break above that level of resistance. That may not be a long-term short play. But right now, I'm waiting for the stock to break back below. Once it does, that gives you a good look at that over and over. Over and over. It gives you greater opportunity to sell that stock short. Or buy puts. Hey, Providence, does this stock have options? AMBC. Check that for me. That may not be a bad option play as soon as the stock's price goes below the 20. What else is in here? Downward trending stock, earnings going down. I would take that. I'm not touching that. Downward trending stock, broke down through the level of the 20. That might be a good stock. You also have to look at the short interest, the float and the liquidity of the stock. That's why I wanted to know if it had options on it. I don't, not everybody's still in the room is as option savvy as you are, Rhode Island, so just keep that in mind. All right, just keep that in mind. All right, so that's some of the stocks that were being generated by the watchdog. How about on Contras? Let's go. Nothing's on Contras yet because the MACD hasn't crossed it. It's not. It should. I'm thinking that it should. Current results, activity log. Not sure why nothing is triggering here yet. I got to check into that. Yes, that company has options. All right, that's cool. All right, so hopefully part 2 of growing our portfolio, dealing with market timing is important. So that was an integral part of setting up this fully automated portfolio that's still doing well. Even though it's getting hurt today, look at the equity curve of the portfolio. Look at the equity curve of the portfolio. Hopefully, part 2 of this mini-series, learning about market timing, has made sense. And learning how to do this easily is the fundamental foundation of what we're doing here. All right, so learn it. Learn it. Put it in your memory banks. These steps are going to slowly but surely get you to a point where you can easily grow the profits in your portfolio. All right, with that, folks, I'm done. Thank you for taking the time to watch this video. Now, if you're new to the software or would like refresher information about the software, click on this Getting Started video right here. Thanks to all of your input, here's a YouTube video that we think would be perfect for you. Click right here. If nothing else, folks, just hit the subscribe button right here.